Hi everyone, we'll get started. Welcome to another session of Ask the Analysts. My name is Sarah and I'm filling in for Mark today. He will be back next week. So just a little background, I'm part of the editorial team here from Morningstar and I'm really looking forward to today's session. So what I've noticed is the companies under coverage really do speak to the theme of quite defensive, which I know in this environment is quite a topic of interest. So let's get into it. Before we get started, I'll just give a message that the information today is general advice. It does not take your personal circumstances into account. So I'll put up the slide so that you can all see the companies that will be under coverage today from our analysts. Please bear with me. Here we go. So keep these companies in mind today when you're putting your questions in. We'd love to hear from you. I'll get Adrian and Shane to both introduce themselves and go through the kinds of companies that they do focus on. Through this list, you'll see that there's healthcare, we've got quite a broad range, utilities, infrastructure, logistics, and even some REITs. So Shane, maybe we'll start with you. A little bit of a background on yourself, what you do here at Morningstar and what kind of companies you cover.
Yeah, thanks, Sarah. Good afternoon, everyone. Hope you're doing well. My name is Shane. I'm not as smart as Adrian, but we both studied engineering at commerce at the same uni and I guess get along okay. At Morningstar, I've been covering Australian healthcare, which is my sector, for about 3 years. But been analysing stocks for close to 10. Before this, I was previously on the buy side at Renaissance Asset Management, mostly covering healthcare there as well, but that was mainly small caps outside of the ASX 100.
Great. And Adrian is not in person with us, but he's over Zoom. So Adrian, we'd love to hear a little bit about your background and the kinds of companies you cover.
Okay, thanks, Sarah. So I'm a senior analyst in the team. I've been at Morningstar for about 15 years. Before that was in credit research. Since I started at Morningstar, I've been mostly covering infrastructure and utilities and REITs, that kind of thing.
Great. So I'm going to stop sharing the screen now. In the chat, there should be a list of these companies if you do forget. But we will be getting to your questions very shortly. Please do send them in. What I'm noticing is the theme, it's fairly defensive today. Healthcare, utilities, screening from, what I'm seeing is quite, on the whole, overvalued to fairly valued. But of course, there are opportunities everywhere. So we'll dive in. I guess before we get started, let's look at some of the announcements this week around the federal budget. It has been, a few announcements in these sectors particularly. We've seen some measures around bulk billing. We've seen some measures around cost of living and energy support. Shane, any material impact on companies that you're covering based on these, or is it all really just consumer focused? It's not going to flow through.
Probably the biggest piece of news from the budget is the new bulk billing plan. It basically means that Medicare will cover more GP appointments, particularly for children, pensioners, and people in rural areas. Making GPs more affordable should improve volumes for diagnostic testing, which will obviously benefit Sonic, Helios, and Integral. Last month, it was also announced that there'll be a 4% fee indexation for imaging services in fiscal 24. So there's some inflation protection there as well. For us, we already factored in that volumes should normalise and put in the new indexation. So we're happy with our forecasts. I would say overall, though, nothing super material from the budget in our view.
And Adrian, anything for the energy companies particularly?
It seems pretty similar to what Shane was saying. Fairly modest positive for companies like AGL and Origin, with more government support helping households pay their utility bills. That's good news for AGL and Origin, just in that they should have less bad debts, probably see less switching to other retailers. So just a mild positive for them.
So while we're still waiting for a few more questions to come in, Shane, let's go to something that I'm sure everyone wants to know, some of the best or most interesting opportunities in your coverage.
Yeah, look, it's pretty hard, honestly, to pick one, and diversification, I guess, is always your friend. So I'll give three that we like. The three names we would recommend are ResMed, Ansell, and Ramsay. All three are trading at a discount of just over 10%. And we view all three as really quality companies with a narrow moat. ResMed had a really good third quarter with strong device sales in the highest quarter of new patient setups. And it's well positioned for the long term as supply constraints continue to improve. In contrast, Ramsay had a pretty average third quarter with margins still slow to recover. But we think the market has overreacted here. The third quarter is generally seasonally weak, and this time we saw a lot more Australian doctors take summer leave for obvious reasons. The share price was nearly $70 just a month ago, but we don't think the story has changed that much, with European currencies also getting a lot stronger. Finally, with Ansell, the margin recovery story that we've sort of expected is still playing out. They've sold through higher cost inventory, and management guided to margins improving again in the second half. They basically increased prices, and supply chain issues are normalizing. Manufacturing PMI indices, which Ansell's industrial segment is correlated to, have also been trending up since December. So we're still confident Ansell is a buy as well.
Great. And how about you, Adrian?
Well, the best opportunities in my space, I think, are AGL and Horizon. They're both going to have pretty weak earnings this year, FY23, but we're very confident that their earnings will be much better next year, which is just a couple of months away. So for AGL, that's going to be driven by stronger retail electricity prices. They're going up by about 20% in most states on the 1st of July. So that's going to be a massive boost to their earnings. And even after the recent share price rally, it's still on a PE ratio of about 9 with a big yield. So we think that's attractive. And similar for Horizon, earnings this year are going to be pretty weak because of wet weather impacting coal mining and exports of coal. But then we expect that to bounce back, earnings to bounce back strongly next year. And that's going to be driven by not just the recovery of volumes, but also CPI-linked haulage tariffs and also higher allowed returns on its regulated Queensland rail track. And once again, the valuation metrics look attractive. It's on a low PE ratio of about 12 and offering a big, almost fully franked dividend yield of about 6%.
So I'll just stick with Horizon. We've had a question from David. Thanks for the question, David. Just on Horizon, appears to be highly thought of by Morningstar, as in, we do cover Horizon quite favourably. It's a freight rail operator. The question says, I note the dividend has steadily decreased and it remains highly leveraged to the coal industry. Can you comment on the long-term future of Horizon as a defensive income producing stock?
Yeah, good question. So the dividend's fallen for two reasons. Firstly, earnings fell because, as I said, the wet weather impact. And then also they've cut the dividend payout ratio because they want to maintain more earnings to reinvest in other parts of the business to diversify away from coal more. So our view is that the long-term outlook for the coal part isn't too bad. The vast majority, like we're talking 95% of Australia's coal gets exported to Asia. So there's thermal coal for use in power stations, there's coking coal for use in making steel. We think the outlook's pretty solid for both of those. Asia's got some very young coal power stations. They're not just about to turn them off. They're going to keep running them. And in fact, they're still building, particularly places like China, Vietnam. So even though coal usage in the developed world is going to fall, our exports go to Asia, and Asia has a positive outlook. So, the International Energy Agency, and we agree that they think that thermal coal demand from Australia should remain pretty stable for coming decades. And it's kind of the same for coking coal. China has been a big buyer of our coking coal. it's probably going to fall off a bit, but then we've got India and other Southeast Asian countries that are kind of picking up the slack. So we think there as well, the outlook is actually pretty stable. And so in the meantime, Aurizon is going to be reinvesting more of their earnings into growing the bulk part of the business. So that's everything that's not coal. There's going to be more iron ore, more copper, more lithium, anything that we're going to be exporting from the mines in Western Australia, South Australia, Northern Territory. Aurizon's well placed to kind of get a piece of that action. So I think the outlook isn't as bad as some people will make out. And then when you look at the starting valuation metrics, low PE, big yield, I think it's pretty attractive.
Shane, we've got a question for you from Tom, and it's to do with the health sector as a whole. I suppose stocks, they generally are overvalued at the moment. Looking through the list, I'm seeing quite a few 2 and 3 star stocks in this space. Is there any reason, Tom asks, not to look to Europe where big wide moat pharma companies seem far cheaper? For example, Roche, I believe, is 5-star, GSK, other companies 4 stars, out of scope. But why are these great companies cheap? I mean, you probably can't specifically talk to those companies because you don't cover them, but are there opportunities for these companies that are screening as, I suppose, fairly valued and overvalued at this space at the moment?
Yeah, it's a tough question to comment on for me personally, because I'm only analysing Australian healthcare. And you're right, like across my coverage, I would say the pandemic was really positive for most of my names, the most obvious being pathology providers, Sonic and Helios, that saw really big gains from PCR testing. Demand was also really high for Ansell's single-use gloves and Fisher & Paykel's ventilators. But since all of that has sort of normalised and demand has gone down, we sort of used to view the sectors being overvalued on average by roughly 20%. But I think right now, with things sort of normalising now and earnings reverting, we sort of view it more as fairly valued at the moment. And we still see quite a few buying opportunities, even in Australian healthcare. So like I mentioned, ResMed, Ramsay and Ansell, we think are really strong. Even CSL, it's really hard to buy a company of such quality at like a decent price, and we think there's upside there as well. And in this environment, when you're trying to find a place to invest your money, the defensive reasons that healthcare provides, I think healthcare not only is quite attractive, but offers some safety as well.
Mm-hmm. So sticking with the global theme for both of you, Andrew has a question. Just, looking at some of these companies that you're covering, they also do have global exposure, as in, they're listed here, but they may have a big portion of their business operating overseas. So is there a way to quantify global exposure of shares listed on the ASX? I suppose, narrowing this down to your coverage specifically, maybe Adrian, there's a few that I know that do have quite a lot of exposure overseas, maybe Atlas Arteria. It's a toll group. I guess most of its revenue does come from Europe. Is that right?
Yeah, that's right. Look, we don't have a good way of giving you a blanket answer of this is how to quantify global exposure of all the different shares. It's just case-by-case basis. You just have to look either at our research or at the company presentations and get an idea of what percentage of their earnings are coming from foreign operations. It's not a data point we necessarily capture and can easily give you an answer on.
Yep.
I guess just from my perspective as well, like having global exposure is good as it diversifies your earnings revenue streams. But I think the main sort of themes, even in the defensive sectors me and Adrian cover, is that inflation is still high and cost pressures are still being felt globally. So that's just another thing to keep in mind of.
We've had a few questions. We did touch on AGL, but we've had a couple of additional questions around. So Adrian, do you have anything to add? A question from Bronte just around the future of AGL's business model. Perhaps, I'm not sure, the shift towards renewables, perhaps. How do you see AGL's future?
Yeah, good question. So currently AGL is a massive producer of electricity, but it wasn't always that way. It only bought those big coal-fired power stations about 10 years ago. So as time goes by and these big power stations close down, I don't think AGL will still be a big producer of electricity. It's not going to replace all those coal power stations with wind farms and solar farms. And the reason for that is that there's a huge number of companies out there that want to build wind farms and solar farms. And with all that competition, the returns from building them are actually quite low. So what AGL will do is it will just use its big customer base and leverage that and negotiate with third-party wind farms, solar farms, long-term supply contracts. So they'll get that energy. AGL will build more batteries and it'll build more gas-fired peaking power stations to kind of fill in the gap when the solar and the wind aren't producing enough power. And then that way it can package up steady electricity to sell to customers. So it'll still have a very vital position, but it won't necessarily be producing all of the power itself. So I think that's the way AGL's business will evolve over the next couple of decades. And it's not necessarily a bad thing. It's just the way that makes sense for them. They've got to invest in the things where they've got competitive advantages, and building wind and solar farms, no one really does. It's a very competitive very competitive business.
We've got a question around Qube, so we might continue with you, Adrian, on this one. Question from David: can you comment on your thoughts for the long-term performance for Qube?
Okay, Qube's a stock we like. It's got really good management and we like their strategy. So it started out pretty humble origins, and they've just been kind of buying and developing new parts of the business to make it a bigger, more vertically integrated logistics player. So, and it's really achieved amazing things, and I think that will continue. So we think it's got a positive outlook in terms of the economic outlook. If we go into recession, sure, that's going to hurt in the near term, but over the longer term, you'd still expect Australia to have economic growth, population growth, growth of imports. So that means more containers, growth of exports of commodities. Qube's got its fingers in that pie. So I think it's got a very good long-term outlook. It is fairly valued though on my numbers.
So we've got a question, and it's on Sonic Healthcare, 2-star, narrow moat. So Shane, this one's for you. Your assessment on Sonic Healthcare, has it changed at all?
I think from the result, I think my takeaways was that it's still performing well and gaining market share. Sonic's Australian pathology business in the first half was up 8% versus the market of 6%. And imaging was also up 8% versus the market of 3%. It's also benefiting from industry trends to higher margin tests, such as gene testing in pathology and higher margin modalities in radiology, like MRI and PET scans. Less coronavirus in the community is also positive for hospital volume. So the base businesses should continue recovering. But essentially, we think the upside is sort of priced in now. And margins, I guess, are still under pressure with some COVID revenue to still come out. So currently, we think it's slightly overvalued for us at the moment. That being said, like Sonic Healthcare, is a very good sort of dividend paying stock. It's something that you can bank on consistently for a long time. It's paying about a 3% yield, but it has a progressive dividend policy. So it's not based on a percentage of earnings, but aims to increase regardless year on year. And Sonic's annual dividend has never decreased since it started paying one in 1994. So quite a long track record there. But yeah, just at current levels, we think it's probably slightly overvalued.
So this one is, a bit of a blanket. So make your pick, I guess. What companies are being reviewed for as best suited to cope with any recessionary forces? We are in a pretty defensive space, I guess, here at the moment. Adrian, maybe we'll start with you.
Yes.
Under your coverage, any companies stand out?
Yeah, look, a lot of my companies are very defensive. Infrastructure, REITs and utilities. So, their revenues are all going to be pretty solid in a recession. So I guess the bigger issue would be, does a recession lead to some sort of a credit crisis? And in which case you might want to avoid the more highly geared stocks or the ones with the worst credit ratings. So they should all have pretty defensive revenues, but then you also just have to kind of look at the balance sheet. So I think for most of mine, they're all pretty well placed. I'm not too concerned on the balance sheet.
Yeah, even for me, we've got a lot of companies in healthcare that are defensive and do well or better in a recessionary environment, just because demand for healthcare products and services is inelastic. It's not as cyclical compared to other sectors, which means companies basically have pricing power to pass on increasing costs, and the impact of demand will be not as great. When we're talking about pathology providers or diagnostic providers, while we think Sonic is slightly overvalued, we think Helios and Integral are trading at a discount. Particularly Integral, which we initiated on recently. It's a really nifty, dependable business at a decent price. It's currently dealing with wage inflation and labour shortages, but we think that should alleviate, particularly with accelerating visa processes that just got announced, and patient volumes will continue to grow. And there's also inflation protection there, because Medicare fees for imaging services is indexed. And like I said previously, that was announced at 4% for fiscal 24. They've also got extra capacity to comfortably accommodate additional volumes, which means sales should largely flow through to earnings. And compared to Sonic and Helios, Integral specializes in sort of the higher margin modality stuff, so MRI and PET scans. They also focus more on regional areas where growth drivers like aging populations are probably higher. Apart from Integral, I'd say, Ramsay. It's like the #1 private hospital provider, and the staffing is improving, and we think that's a great margin expansion story as well.
So we have a question actually from Howard on Ramsay. Is Ramsay still of interest to private equity? I presume this is in terms of takeover target?
Yeah, I mean, like it got bid at quite a premium to our fair value. And I think because the buyer required due diligence for Ramsay Santé, which was a competitor to them, the deal got turned down. Right now, we don't see any interest currently that we're privy to. But yeah, particularly given the large swings quarter to quarter. Second quarter, they had a really good result. Share price was around 70. Third quarter, probably below expectations. Share price now 60. I think there is opportunity right now to buy it at a discount. And we don't think the story has changed. Like I said, margins will continue to improve, I think, as case mix and volumes normalize, and Ramsay realizes efficiency from its digital investments. The firm's also well placed for the long term as it benefits from additional capacity in its development pipeline. And management still expect things to improve through 2023 before conditions eventually normalize in fiscal 24, and we'd sort of agree with that view.
Great. We've got a question, Adrian, for you from Phil. and it's around Waypoint, which is a REIT. It's 3 stars, and we've recently initiated coverage on Waypoint, from what I understand. It operates a portfolio of around 400 service stations and convenience stores. So this one's quite an interesting one. The question is, has your fair value estimate changed for Waypoint?
Yeah, okay. No, it hasn't changed. I think it's a pretty attractive little REIT, very, very defensive, at least in the medium term. It's got that longer term ESG risk. We think that's manageable. But, very, very certain earnings, fixed rental increases, decent balance sheet. So a pretty decent option with a big yield.
Great. I think we've had a couple of questions around dividends. So I just wanted to ask, maybe we'll just jump right in and say, what do you think is the best paying dividend stock in your coverage? Maybe we'll start with you, Shane.
Yeah, I guess I already mentioned Sonic Healthcare. Also, Ansell is trading on about a 3% dividend yield. APM as well is, I think, the highest at 5%, but that's sort of a bit outside of the healthcare sector and a bit more cyclical. But yeah, I think you'll probably find higher yields in some of Adrian's stocks, to be honest.
All right, we'll go to Adrian.
Yeah, look, there's a lot to choose from in my sector, a lot of big dividend yields. So obviously AGL Energy and Horizon, I've talked about those two, both have mostly franked yields over 6%. Then Waypoint, which was brought up, also big yield of about 6%. And that one's probably a bit more certain. It's a bit of a safer, medium uncertainty stock. Then let me see, I'm just going through my list. There's also some other REITs. They're all got yields of like 5%. APA Group's another good one, actually, that we like, 5.5% yield on that. So those are probably my top picks. And then, there's some New Zealand utilities as well, which have decent yields, like Manawa Energy and Contact Energy. So yeah, look, there's a lot to choose from in my space.
And what about
my favourites are probably those, AGL and Horizon and Waypoint.
What about BWP? I suppose while we're on the topic of REITs, I know that this is a stock that's of interest because it operates it owns the warehouses that are leased to Bunnings Warehouse, owned by Wesfarmers. It's Wesfarmers is obviously or Bunnings particularly did really well during COVID. It's still a huge amount of upside. BWP doesn't necessarily capture that upside, but is this a company that we like, given its overexposure to one tenant?
Yeah, well, it's one very good tenant. So what that means is it's got very, very safe revenue, and it's growing, not particularly quickly, but rents on some of the leases, probably half, go up with CPI, which is pretty high. And then the other half go up at a fixed rate of 3% or something. So it generates some solid revenue growth. So very strong defensive revenue. Balance sheet is also very, very strong. It's got very low gearing. So it's pretty much bulletproof from that perspective. But then it's also we're not expecting much dividend growth, distribution growth, because as interest costs are going up because of higher interest rates. So the 5-year outlook, so the yield at present is it's less than 5%, maybe 4.5%, and we don't expect any growth for the next few years because of higher interest rates, and also because Bunnings is leaving a lot of their older stores. So Bunnings is upgrading typically to bigger stores nearby. So for BWP Trust, that means that they've got vacancy, they've got to redevelop or sell the site. So that's a bit of a headwind. So there's some things that we really love about the stock, the defensive earnings and the low gearing, but then it's not cheap, and it does have this bit of a headwind to growth over the medium term.
So we'll turn to CSL now. I know that is a stock that everyone loves, but it is one of our more expensive stocks under coverage. It is currently, I think, 3-star. Given the price, do you think it's worth investing in, Shane? Or is there more value investing in other high quality stocks which have a lower stock price?
Yeah, firstly, I'm sure most people know, but you can't really compare stock prices. Even though CSL is trading at $300 a share, each company has different amounts of shares on issue. For example, if CSL did a 10-for-1 share split to boost liquidity, the share price would be $30, but it'll still cost you the same amount to have the same share of ownership. That being said, we do really like CSL. Our fair value is $3.15, so it's trading at maybe like a 5% discount. But it's a really high quality company. The supply of plasma is clearly coming back and is well above pre-pandemic levels. And that's coupled with plenty of excess demand for its products. Diagnosis rates are continuing to improve as things open up, and we're very positive on the long term, given demand is sort of underpinned by chronic indications. But yeah, like I said, it's only trading at a 5% discount at the moment. So I'd probably recommend either ResMed or Ramsay for a similar amount of quality, but just at a better discount at the moment than CSL.
Is it hard to get CSL at a discount?
It is hard. It's always, of that company, when their product portfolio is so diverse, it's quite rare. But yeah, it has been trading at 300 for quite some time now. So we think the opportunity is now because in our view, for CSL, gross margins have sort of bottomed. Management are really positive on the second half because with the supply of plasma coming back, you're going to see the operating leverage come back as well as sort of labour and overhead costs scale with normalising collections and volumes. Management also mentioned that the cost per litre of plasma collected has declined roughly 10% from the peak in 22. So that, it really gives us more confidence that CSL is on the right track.
We've had a few more questions around AGL. I know this is a popular stock. So Adrian, a couple of questions. One, it's just around the disruption to the management and the board at AGL. I know that, there's been a bit of activist investor going on there. Has it settled down? And any other comments around that disruption? And the second part of the question for AGL is just around uranium, a huge amount of uranium in Australia. Will AGL ever tap into this source?
We're just answering the second question first. I don't think so. I think that's pretty unlikely. It seems the way we're going is wind, solar, and batteries and gas-fired peaking power stations. In terms of the first question, the disruption, it was a really awful time for AGL. There was a lot of disruption, a lot of new members to the board. There was also a lot of fairly senior staff leaving the firm. But that has all calmed down now, and the business, from all I can tell, is that it's getting just back to building itself up again and steadying the ship. There's been a lot of questions about, now with these extra board members, are they really looking after shareholders? And the feedback I get back from investor relations is that definitely that's their main goal, is to look after shareholders, but they just do it with a bit of a different lens. So I think, yes, everything has calmed down now.
Shane, over to you. We've got a question around Avita Medical, 3-star. And I believe this company provides treatment for skin burns. The question is, the share price has performed well this year. Is profitability like to be achieved soon? And do you see more upside?
I mean, they report tomorrow, which is, it's on my mind. But I don't expect any surprises there from tomorrow. They're on track to launch their resale product for soft tissue in July, which sort of brought forward the path to profitability, I'd say, or made it more clear and realistic for investors. The guidance they've given is really encouraging, but there's still a wide range of outcomes in terms of how fast they make it to profit. on our forecast, we still think it'll take until 2026 calendar to be cash flow positive. But the important thing is that we don't expect any additional funding there. And our assumptions, we think, are maybe a bit on the conservative side.
Back to REITs. So Adrian, you don't necessarily cover, you don't cover all the REITs, but the question specifically is around office REITs being out of fashion at the moment with what's going on globally and with rising interest rates and the work from home shift. Are warehouse REITs, more likely to maintain or grow earnings?
Yes, I'd say so. Office vacancy is pretty high. Tenant incentives, leasing incentives, when you lock in a new tenant, they're very high as well. So that's definitely the office class that's suffering the most. I don't cover any of those. Those are covered by Alex Prineas. But it's pretty obvious that warehouse REITs are doing much better. There's very, very low vacancy rates in industrial property in Sydney and Melbourne, and we're seeing massive increases in rents. But the thing, I guess, to bear in mind is that REITs always use, especially industrial REITs, they have very long-term leases. So for the most part, the REITs aren't seeing that much benefit from very strong rents. They only have a handful of leases up for renewal each year. So on those, they'll be getting very big increases. But for the rest of the portfolio, rents will just keep tracking higher at like 3% per annum or something. So you should expect some pretty solid revenue growth for those warehouse REITs. But it's not as good as you might imagine when you read in the newspaper that that warehouse rents are going up by crazy amounts, 50% or whatever. So it's definitely a better place to be at the moment, but maybe that's already priced into the share prices. And like I mentioned, they all have this headwind from rising interest expense, because REITs use a lot of debt. Interest costs are pretty much their biggest cost. And now with interest rates going up very significantly, doubling or even tripling for some of them, that's a major headwind to earnings. And it also hurts their credit metrics as well, which could see some forced to raise equity just to maintain a decent buffer to their debt covenants.
Wanted to ask you a question, Adrian, just around the fact that you've got quite a split between companies here and in New Zealand. Is there a difference or effect on stock prices depending on where an energy stock is based?
Well, yeah, it's a good question. There's no difference really based on where it's listed per se, but if you look at the Australian utilities, they're very, very different to the New Zealand utilities. In Australia, AGL and Origin, they're very reliant on coal and gas-fired power stations. In New Zealand, they're hugely into renewable energy, because in New Zealand, you've got some amazing hydroelectric schemes. You've got geothermal power stations with all the volcanic activity. And obviously, it's also pretty good for, it's a good wind resource, they say. So those New Zealand utilities are kind of really well placed for the future, just because they've already got so much renewable power. It's just that New Zealand's a much better place for renewable energy than Australia. So the Australian utilities, they have a much more difficult future using their earnings from the coal and the gas now to try and build out the renewable energy and transition. It's a big job. Whereas in New Zealand, they're already kind of well placed. But when you look at the valuations, that's already priced in. The New Zealand utilities are much, much more expensive on any kind of metrics like EV, EBITDA, PE ratios, dividend yields, much more expensive than companies like AGL.
Okay, we'll move to the narrative going on at the moment. I suppose rising interest rates. We've just had the 11th, I believe, this month. And the impact on growth stocks. So particularly in your space around healthcare innovation, do you think there's any truth to rising interest rates impacting this growth? And from your analysis, have you seen this affect any of the healthcare stocks you cover?
Yeah, I think from a modeling perspective, it definitely makes sense. So when interest rates rise, the discount rate analysts use should increase, which lowers stock valuations across the board. But because growth stocks have cash flows weighted further out into the future, they're more sensitive to rising rates. So typically, when interest rates rise, you see a rotation out of stocks to bonds, and within equities, a rotation from growth to value, particularly when investors are looking for safety and less tolerant of risk. Yeah, talking about Avita Medical, I think that's a good example of a small biotech which got sold off hard and was trading just over $1 last year. Like many small biotech names, it was burning cash and highly dependent on those future cash flows to get profitability. But we kept our fair value around 550 since March last year, and it's been a great call for us. And I think the catalyst, like I said, for a share price recovering was the chance of profitability in the near future becoming more realistic.
Moving to Transurban, Adrian.
Yes.
Do you think that there's any risk we'll see a downturn in the economy and weak economic conditions? Sorry, risk if we see this downturn?
Well, yeah, like if we have a recession, then you'd expect higher unemployment and less construction work, less consumer spending, all that kind of thing, and that could see a modest reduction in car and truck movements on their toll roads. But generally speaking, toll roads are very defensive, so you wouldn't think there'd be a big impact. You know, even in the GFC, toll road usage only fell by a few percent. Like I mentioned before, I think the bigger risk is just more about whether the recession triggers a banking crisis or something, and then banks kind of pull in their heads, reduce lending, and that could make it difficult for companies with high debt levels like Transurban to refinance their debts. For this company, we think things like the pandemic, for instance, was a much bigger impact on their traffic volumes than recession.
Keep the questions coming in, guys. We still have a little bit of time. We'll move over to ESG. So it's becoming more popular. Investors are a lot more aware about ESG. So this question's for both of you. Maybe Shane, we'll start with you. Do you think any particular stock in your coverage poses any ESG risk? If so, would that impact the share price? And maybe explain as well what you consider when you look into ESG in healthcare.
The short answer is no. We've gone through potential ESG risks for my entire coverage, and I guess for healthcare companies, in the context of them providing essential services and products, these risks are pretty minor. Generally has to do with IP or how well they can keep their staff and retention, and not really massive deal breakers. There are definitely bigger issues in the energy space. And yeah, I guess the rise in coal is one of them. So Adrian can talk to that.
With healthcare, what would the considerations be? Because they're, for context, environmental, social, governance. Are there any companies that you've covered that have really, I suppose, in the latter two, slipped up or not met expectations?
I guess the only one that comes to mind is Ansell. So their rubber gloves are made from nitrile butadiene rubber, which is maybe a byproduct of petroleum. And they've also dealt with maybe labor issues around cheap labor in some of those international countries. But those are issues that they've been able to resolve, and even in terms of their rubber portfolio, they're trying to move more of their products into sort of like latex and more neoprene, more like environmentally friendly materials. So yeah, that's the only one that comes to mind in healthcare.
I suppose it's probably a lot more prevalent and obvious in your space, Adrian. What do you think?
Yeah, it is. It's a much bigger deal in my space, I guess. They say ESG, but everyone just focuses on the E. and in my space, we've got AGL and Arise and Origin Energy all exposed to coal. But I think to a large extent that's now factored into share prices. Their share prices are a lot lower than they were before. The rest of my coverage kind of doesn't look too bad, but there are always risks that we're keeping our eyes on. For example, it's entirely possible that car ownership could reduce over the coming decades, and that could be a headwind for toll road owners like Transurban and Atlas Arteria. There's also APA Group. They own gas transmission pipelines. So, if we burn gas in power stations, then that produces carbon dioxide. So some people might think that's a negative, but gas is actually great in another respect because it helps us close down coal power stations and build more wind and solar, and then back that up with quick start gas-fired power stations. So on a net basis, gas is actually a win for the environment. But it's just something we'll have to keep an eye on. But at this stage, I think that they look fine.
So just sticking with you, Adrian, we do have a question from Stuart just around AGL again, specifically for dividends. So will it ever go back to paying high dividends and 100% franking as it did 15 years ago?
Yeah, look, I think one day for sure. Never say never, but in the medium term, AGL is going to have to reinvest a fair bit of earnings. So the dividend payout ratio, I think, has actually got further downside in the medium term. So dividends should go up just because earnings are going to go up by so much in FY24. But I think AGL will take the opportunity to reduce the payout ratio just so they can save that money and reinvest it into batteries, into seeding, wind farms, solar farms, into their energy hubs. So they've got a lot of money to spend to transition, and as such, they can't really afford to pay out a massive payout ratio.
So I just wanted to move on to the theme of economic moats. Looking through the coverage list, quite a lot of them under both of you have got narrow moats, which means that a moat basically is a sign that the company can hold off competition. So what do you think it is about these spaces in particular? What is it that validates a moat under your coverage? Maybe Shane, we'll start with you in healthcare.
I guess the best example of a moat is probably Cochlear, which we've assigned a wide moat. It's just like such a solid business in terms of the services and upgrade segment. It's basically an annuity stream. So when someone gets implanted a Cochlear device, they're basically attached to Cochlear for life to get any sound processor upgrades or services. But yeah, Cochlear, just on valuation, we think it's expensive. Cochlear have dominated the children market in developed countries with over 60% share. And that's also a sign of how hard it is for other competitors to sort of compete with Cochlear. But just the strategy is sort of shifting now towards people over 65. And in this market, they have to be a lot more competitive on price, given that they're competing with hearing aids. So we think that's a big driver of sort of average selling prices declining as they get less reimbursement support. Hearing aids are also an easier sell for elderly patients because they don't have to go through a major operation or surgery. So I think that market is quite tough, and we think the stock's overvalued. But still, the business itself, it's very hard for competitors to compete there.
And Adrian, quite a few narrow moats. So, competition at bay for about 10 years plus. What do you look for in moats for the companies you cover?
Well, look, it's different. I cover quite a range of different companies, and it's different for all of them. But typically, they've got to have some sort of cost advantage, some sort of monopoly assets. If we look at the New Zealand utilities, they've all got narrow moats. They own, as I mentioned before, these amazing hydroelectric schemes, no one else can really build any more hydroelectric schemes in New Zealand. You have to build something inferior to produce more power. So the owners of those assets are in a really good position for a very long time. The only reason we wouldn't go wide is because utilities have a lot of regulatory risk. So that's what's kind of, the assets themselves are brilliant and they will be for a very, very long time. It's more just around that regulatory risk. Companies like AGL, kind of similar, you know, they've got some very cheap coal supply for the next 15 years. So so they can produce electricity cheaper than pretty much everyone else. That's an advantage to their competitors. Same with, you know, companies like Transurban, Sharesight, they own assets which are basically monopoly assets. So yeah, that's, looking through my list, that's kind of explains most of them, of where the moats are coming from.
Yeah, and we've got a question around APA, so gas infrastructure. It's got a narrow moat, and the question is, what's it doing in regard to renewables?
So APA is branching out, or has been for the past decade, into wind and solar farms. They're always expanding. So yeah, so a lot over in WA, and in particular, they're kind of doing it together with their pipelines. So they'll expand their pipelines into remote areas, put in a gas-fired peaking power station, put in some batteries, put in some wind farms or solar farms. So that is a core growth area for them. I'm not a massive fan of the whole renewable investment. I think their moat is really about their gas transmission pipelines. I don't know if you've ever seen a map of their assets, but they've pretty much just got the majority of the long distance gas pipelines in Australia. And I think and it's interconnected. So it's a network with lots of nodes, lots of places to put gas in and take it out. I think that puts them in this really strong position. So the more they invest in that, I think they get strong returns on that. If they go out and build a wind farm or a solar farm, you know, they've got to compete with a lot of other players. I don't think the returns are that attractive, but nonetheless, the business does want to just, I guess, diversify. They don't want to just be exposed to gas. So that's what they're doing in renewables. They're investing in anything, wind, solar, batteries, anything you can think of. They'll get into it in particularly in WA.
So we're almost out of time, but I wanted to turn to overvalued stocks. So Shane, you've actually got a couple of one-star companies under coverage, Pro Medicus and EBOS Group. So why do you think they're overvalued?
I think Pro Medicus is our most overvalued stock. It's basically a tech stock. It's not really a healthcare stock. And it has one main product, Visage 7, which is a software application that radiologists use to view images from any device and make a diagnosis. It's resonated most with US academic hospitals that typically have large endowments and greater interest in advanced visualizations and AI. But we think these features are pretty unnecessary for most normal hospitals, and wider uptake has been quite slow. The other thing is that while we think Pro Medicus right now is amongst the best in the industry, there are low barriers to entry, and large competitors, the likes of Fujifilm, GE Healthcare, Philips, that sort of own the legacy systems, they're really incentivized now to compete, and they're already using similar forms of technology. So we think competition will heat up, and yeah, it's a sell for us.
And Adrian, you don't have, from what I can see, 1 stars, but you've got quite a few 2 stars. So who's overvalued, and why would you maybe steer clear at this price?
Okay, yeah, so Meridian Energy, Transurban, Port of Tauranga, and Mercury NZ. Look, they're all good quality companies, narrow and wide moats. They've got good longer term outlooks as well. It just comes down to valuation. So they're all kind of market darlings, I guess, and we think they're all a bit too expensive. Low yields, high EV/EBITDA multiples. And so they're all trading, 20-30% above my fair value estimates.
Great. Well, that takes us to the end of the session, 1 hour down. Thanks for joining us. Thanks for all your questions as well. There will be a link to this recording put on the website. Shane, Adrian, thank you both for your insights. Really, really interesting. Really appreciate your time. Giving us 1 hour of your time is a really big chunk of time out of your day. So we appreciate it. Mark will be back. So I've been filling in for him today and he'll be back next week. So enjoy the rest of your day. Thank you.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.